Welcome back to another episode of What's on Your Mind. It's been about a month since our last episode aired in the middle of May, and a lot's happened since then. Markets or economies have started to reopen around the world. The S&P 500's up about 10%, but all the while there does seem to be this kind of overcast of uncertainty in the world around us. So to provide a bit of clarity with that, we're lucky enough to have Jason McDonald and Anthony Iser on the call today. And gents, it's great to have you both back. These guys are going to talk through some of their market perspectives and also some ideas going forward. So let's get things started with you, Jason. Why don't you share some of your thinking on markets at the moment?
Yeah, hi everybody. Thanks, Chris. Yeah, well, hopefully we can provide some clarity. Let's see how we do with that. So, yeah, I think it's always important when you're looking at the overall market situation to think of liquidity. So, if we go back to what seems an absolute lifetime ago now, when the market was literally falling with no bid to it, and a lot of that was liquidity related. And so, just as we know that markets overshoot to the downside, they can also do the reverse. And I think it's quite instructive to think about the liquidity situation at the moment with all of the facilities and programs that are out there from, clearly the central banks, plus also what governments are up to. So I just wanted to mention a couple of points on that subject. So we're back into, the kind of familiar or maybe not so familiar alphabet soup that we began the last decade with all these different programs. So forgive me for talking about all these abbreviation terms, but we've got the TGA, which is the Treasury General Account, which is drawing down $600 billion this month, but that's going to be finished by the end of the month. I think also, I'm seeing that by the end of the month as well, I think it's going to be peak liquidity in terms of what's going on with the FX swap auctions. So for those of you, understandably, who aren't familiar with that, that's essentially, very simplistically put, these are international lines of dollar liquidity that the Fed provides to the rest of the world, which they first introduced as an aid and a kind of rescue feature in the last financial crisis 10 years ago. So those things came back into use, and they've been very prominently used by the ECB, the BOJ, and even the Bank of England recently when they were worried about a no-deal Brexit, which of course, by the way, I'm not going to talk about that, but that is, that could be back on the agenda, but let's not go there. So those FX swap auctions is a way of the Fed distributing dollars globally, and they're going from daily to weekly auctions at the end of the month. And as I say, the TGA is winding down the Treasury General Account this month. Now I don't know, if that means that we get kind of more reasonable market movements or sideways movements, but I certainly think that you've got to look at liquidity and stress. And then the last thing that I would mention is the Paycheck Protection Program. So the PPP loans are going to be turned into grants during June and July. And what that means is, and this is fairly current because of, if we think about the rather surprising labour numbers that came out at the end of last week, as a result of that, it means that businesses are going to have a much better idea of where their finances are and hopefully a better picture on where their expected customer demand is, which I think is going to lead them into deciding what their appropriate level of employment should be. So I think that all these things are kind of coming together and basically meaning that we're going to have, don't get me wrong, we're not going to have tight levels of liquidity, but we're going to have reduced liquidity, I think, getting into the end of June, beginning of July. And I think that's quite important to think about in the context of what the market's been up to.
You're certainly right about the liquidity driving things along, the strong liquidity that we've seen, Jason. And good morning or afternoon, everyone. The market has been very, very strong. 98% of companies in the S&P 500 are up above their 50-day moving average. 70% are above their 200-day moving average. and every single company in the S&P 500 is up over the last 10 weeks. You can see the biggest movers and the worst performers on this chart here, and basically it's the low quality stuff is going up. Energy and cruise lines are the biggest movers, but everything is in positive territory at the moment. Just wanted to put up another chart here that shows further that the lower quality stuff's going up. We've spoken about balance sheets in the past. Much of the economic cycle, balance sheets aren't important, but in times like what we've seen in the last 3 to 6 months, they're very important. And weak balance sheets, as you can see from this chart, have been outperforming as people step in and just speculate a little bit more, despite the fact that things are not really improving on the economic front and the earnings front just yet. And just to show, Jason, you mentioned the unemployment numbers that came out last week. Just a chart here showing historical recessions and unemployment and the huge hole, unprecedented, has been searched in Google searches an unprecedented amount of times. And the reason for that is there are so many things that are unprecedented, and this unemployment drop, as you can see from this chart, has really sort of moved in a way that we haven't seen before. It's going to take a big move over a long period of time to get back to the recent highs. But as we've said, every stock's been up, so it hasn't stopped speculators in the market. There's been a lot of sort of hot potato, pass the parcel, whatever you want to call it, with some of these names, right at the bottom end of the quality spectrum. JCPenney's, Chesapeake was a $37 billion company. It's got bonds trading at 5 cents on the dollar, yet people keep bidding that stock up. Now, it fell recently, I think yesterday, as they announced likely Chapter 11, but it's still well and truly in positive territory, and someone's going to get caught holding that bundle. So yeah, I'm a little bit concerned about the speculation that's going on. How are you seeing that, Jason?
Yeah, I mean, I think that's a very current point, Anthony, because so I'm sure that people out there are well aware of platforms like Robinhood and Trading 212, etc. And it may sound like a rather minor point, but I don't think it is actually. So I've seen numerous articles, basically arguing that the trigger to buy something and look for an aggressive rally these days is once they declare Chapter 11. So, one example that really springs to mind is Hertz Global Holdings, which I think we're going to have a chart of in a moment. Now, that stock traded, it's amazing to watch. It traded yesterday as high as $5.80, which is a cool 500% rally since last Wednesday's close. Now, some anecdotal evidence here. So the great thing about Robinhood is that there's an app that monitors in real time what's happening on the platform. And just in the last week, 96,000 people opened positions on Robinhood in Hertz. 96,000 people. The stock rallied, as I say, as high as 500% yesterday from Wednesday's close. There's only one issue with this company. It filed for bankruptcy 2 weeks ago. Now, just to remind people, if they're not familiar with what happens in Chapter 11, so Chapter 11 is the bankruptcy code in the US. Once you file for Chapter 11, it's extremely rare for the equity holders to receive anything back. Basically, the bond holders have to be paid first before the shareholders receive anything. Hertz has got $19 billion in net debt. They generated $4.4 billion in adjusted EBITDA last year, which is an earnings measure. And going back to Anthony's point about the bonds, the senior unsecured notes due 2028 are currently trading, and they were only issued last autumn, by the way, they're currently trading at 29 cents in the dollar. Now, I've seen some rather kind of facetious comments about, dumb money doing much better than so-called intelligent money these days. Fair enough. As one of the other mentors likes to say, winners win. But you ain't a profit till it's in your pocket. And do you think it's really a fantastically well thought idea to be pushing things in that manner when the bond market is telling you something rather different? And we know that equity holders get nothing before the debt holders. I'm going to put my money with the bond market on that one. Don't know about you. Some other things of interest that I've seen. So Macy's, and I'm going to steal somebody else's joke here. Macy's, the famous department store, that stock rallied 39% in the last 6 trading days. And the joke is, so this is since looters trashed their flagship store in Manhattan. And so the joke is, whilst the arrival of corporate raiders has long been a positive catalyst for publicly traded companies, it turns out that actual raiders can be bullish too. So that's how the market celebrated the trashing of Macy's. Some more anecdotal evidence of how things could be getting a bit frothy. So NASDAQ were tweeting their followers last week to explore option strategies more and suggesting that we put on bull put spreads, iron condors, iron butterfly strategies. Those last two, they involve purchasing 4 separate options contracts, by the way. So it looks like people have been taking a bit of notice of the public education campaign from them. So CBOE data shows that call volume as of June the 4th reached 2.3 million contracts, which is the highest one-day total since 2011. And then lastly, on the options front, if we want to look at the put-call ratio, that's now 0.4, which is the lowest reading since 2014. So you want to continue buying it? Be my guest. And then I think there's probably one sector here that really captures the current situation, which I know Anthony's got some views on as well, which is the airline sector. And this will be the end of my mini rant. So basically, as we know, airlines have essentially been grounded since the pandemic started. American Airlines just last week, rose 76%. Now, this is not a penny stock. Okay, it's nowhere near as big as it used to be, but it's not a penny stock. Why might that have been the case? Well, so there is this thing, there's an ETF called Global Jets. It's had 64 straight days of inflows. It had assets of $33 million back in early March. Its assets are now over $1 billion. Over that same period, again, we're back to Robinhood. The number of accounts at Robinhood holding JETS, so that's the acronym JETS, has jumped to 30,000 from 500, according to robintrack.net. So, are we seeing some justifiable moves here in the airlines or maybe something else? And I think it's probably a good time to hand over to Anthony, and I know he's got some thoughts on that sector too.
I do, and I couldn't agree more with you. I mean, with this entire economic slowdown that we've seen, so sharp, so aggressive from COVID-19, it's very hard to see the other side. But airlines are one sector that we do know is going to be impacted for the long term. So to that point, my sort of trade idea, one of the things I've been looking at recently is to sell United Airlines. Like the entire sector, revenue's been ravaged, $43 billion in 2019, going to $19 billion forecast this year. Markets looking for a rebound to $31 billion in 2021. So still a long way from getting normalised, and that forecast is really sort of a finger in the air guess at this stage. No one's got any clarity on how things will be opening up. As a result, obviously these are lots of fixed assets, highly operationally leveraged businesses. as well as financially leveraged businesses. So net income goes from $6 billion to a minus $6.6 billion this year, and still losses in 2021. Main issue for these guys, they've got planes, they've got staff, and they're burning $40 to $45 million a day. That number will go down when in September. Many people were crying that the US has turned into a socialist country, certainly for the big corporations getting bailed out. United, no different. They've received $5 billion from the US government already, $3.5 billion of which is a gift that they don't need to pay back. Unexpected in one sense, totally expected in another sense, and it's provided them with a little bit of a buffer in cash. They've needed to go and raise money elsewhere though as well, so they had a debt raising. They couldn't get away at 9% interest. They had to push it out to 11% interest. So people have got real concerns about their future. I'm not suggesting they're going to go bust, but there's a long way to turn around for all these airlines. They also did an equity raising, $26.50, 40 million shares, 15% dilution. And just to highlight how terrible this is for investors and shareholders, over the last 5 years, they had bought 120 million shares or thereabouts at an average price of $50 to $90. And doing this to boost their EPS, to give themselves nice big bonuses, of which they've been paid out on. And on the 40 million shares that they bought back, that they issued, they've dusted a couple of billion a minimum on that. So even the most uninformed investor would know the basic tenet that you need to buy something lower and sell it higher if you want to make a profit. You can do it in whichever order. You can sell it first and buy it back, or buy it and sell it. But that is a basic fundamental. These guys are buying stock at $50, $60, $70, $80, $90, and then they're selling it back at $26. The management is an utter disgrace, and these companies should be taken to the cleaners, stripped, but the US has decided to bail them out, much to my disappointment. But anyway, that said, even with this bailout, they're in all sorts of trouble. They've got lots of cash on board, almost $9 billion with all these various raisings, but they do have $20 billion of debt. But the biggest issue for these guys is, how is this market going to turn around? So China, obviously further down the path than all the other nations with recovery from COVID-19. Just put a chart up now showing the recovery in their passenger load factors, 2020 versus 2019. You can see the red line there, the solid red line is domestic travel, getting back to where it was last year, still quite a bit below, but no signs of recovery at all in the international line, that dotted line. And that's the reason why I think United is a sell at these levels. They have 40% of their earnings coming from the international segment. American Airlines is probably a worse company, but has more domestic focus, which may help it out a little bit. So the international side of things is going to take a long time to recover. Most markets, until COVID is cleared, whether it's through shutdown measures, whether it's through a vaccine, are going to require 14-day quarantine for visitors from other countries. That's going to massively limit anything but the most essential travel. There's lots of talk of bubbles being set up. The Baltic states have set up a travel bubble because they've managed the virus very well. Looking at bringing in some of the Scandinavian countries, Australia and New Zealand are looking at a travel bubble, and some parts of Asia, Singapore, Korea, and certain segments of China are doing it. No one's putting the US in a bubble anytime soon. The US has mismanaged this in a massive way, unfortunately. So travellers from the US are going to require quarantine in most other places for the foreseeable future, and I think that's a major detriment for the prospects for United in the short term. So I guess that's my sort of bear case thesis for United. You could play that via the options market, but I'd prefer just to short it outright and hedge it with a domestic player in the market, so that then if we're wrong and things do turn around more rapidly than I'm expecting, I think that will be very much on the domestic side first, then the international. So even if we get that international part wrong and it all turns around, we've got a hedge on the other side. So I'd be buying Southwestern Airlines. It's currently the biggest carrier in the world globally with the scheduling it's put back on. It's had 8% compound returns for 20 years. The international component is a few flights down to the Caribbean, and that's about it. Like United, revenues falling off a cliff, 22 billion down to 10, back to 17 in 2021. But it's a safer strategy. They've got better execution, and I think it's a perfect hedge against United Airlines. How are you seeing the stock-specific stuff, Jason? Anything standing out to you one way or the other?
Yeah, it's interesting actually, because I was on the previous emergency room. One of my bear case, one of my short examples was actually EasyJet. Similar kind of situation in terms of, obviously ridiculous cash burn. To be fair to them, we haven't had any government bailouts here yet of the airlines. And EasyJet has done a really good job of reducing costs where it can, but clearly, as we know, airlines have got very high fixed costs and they're very operationally levered. So, again, with them, I'd say that their sort of crucial period is going to basically be July, August time. The UK government comes second only to the US in terms of its farcical antics. So we've just, as of 2 days ago, introduced a 14-day quarantine. Some might say that's only 4 months late, but hey, Boris knows what he's doing. So yeah, I mean, unfortunately, it sounds like a bit of an echo chamber, but I find it very hard to put it this way. I don't think I'd be buying the airlines here. And I think that some of these rallies have just presented us with some pretty good opportunities to actually start shorting into that, selling into it. It's very hard to build a bull case here on those. I mean, if you wanted to pick an industry or a sector that is that could be designed to be as badly hit by something like COVID, this is it. So yeah, I mean, I've been getting a bit of a reputation for being a bit of a sort of miserable old codger. So I do have a bull idea today.
Yay.
It's not the most exciting of ideas, I'll grant you. It's probably not even a typical ITPM long idea, to be honest, because it's actually quite a large company. It's got a $130 billion market cap, so it's not small, but it used to be quite a lot bigger. So yeah, basically my long idea is Wells Fargo, actually, which is it's a bit of an interesting one. It's the ticker's WFC. It's a recovery play. So I'll just talk you through the sort of basics on the metrics. So share price closed yesterday, $32.63. The P ratio for this year, not unsurprisingly, given what's happened to the earnings of many companies across the board for this year, there are 41 times P multiple for this year. That comes down to 13 times for next year. We're looking at earnings dropping 80+%, 82% this year, rebounding next year by over 200%. Now, they've just been affected by the COVID situation, so I'll come on to that. And this is why I'm looking at it as a recovery play. The sector metrics are, so this year, the rest of the sector's on 18 times. Now, that's because, Wells Fargo is still putting through some extraordinary charges for some of their past misdemeanors. Next year, the sector's on 12 times. So basically, Wells Fargo's on roughly the same rating for next year. In terms of the picture for the sector, and in terms of earnings growth this year, you're seeing a drop of 40%. and a rebound of 58% next year. So as I said, banks, not really the obvious call in an economic situation like this. And although a lot of them may appear to be cheap, as we know that now, given what the central banks are up to, unfortunately, the US is now in a situation where it looks like it's going down the same route. And we know what negative interest rates have done to the European banks over the last decade. So, at the moment, I'm setting out a fairly good bear case, it must be said. Lending margins, as in net interest margins, are probably not imminently going to improve, given that the Fed funds rate is pretty much close to zero. I think that actually close to zero is much, much better than negative yields, which is what we have in Europe and other parts of the world like Japan. And I think, if we're looking for a bright spot, then although business loans contracted in the first quarter, they've since exploded. But that is actually what happened in the early stages of the 2007-2009 slump. Actually, business credit demand went through the roof. Now, a large part of that is probably down to companies basically, kind of storing up ahead of rainy days to come, shall we say. But that actually, in the short term has provided a bit of a boost. Now, for those of you that aren't familiar with this company, it's the fourth largest bank by assets in the US. It's the undisputed leader in unwanted regulatory attention in the US. It's, as I say, it's on 41 times this year. It's on 13 times next year. More relevantly, in terms of the banks, it trades at a discount to book value. It's about 0.9 tangible book value. It pays a 6.5% yield, which I think they'll retain. I don't think that's under threat. It's very well funded, so it's the loan book is only 72% of deposits. It's very well capitalized. It's got a tier 1 capital, which is the thing that the regulators look at, of just over 11% on its just under $2 trillion asset base. Currently, you could argue that this is going to go up, but currently non-performers are 60 basis points, and they've provisioned double that for non-performing loans. And quite importantly as well for the US, given what's happened to the oil price, only 1.5% of their credit is actually to the oil and gas sector, which is quite a nice thing. So as I mentioned, they've basically been top of the regulators' agenda in the US for the last 4 years, since 2016, because they were under the previous leadership. A lot of their managers were essentially creating false customer accounts for commissions, which is obviously an incredibly bad thing to do. So they've got a new CEO who took over in October. As I say, they've been paying fines and in discussions with the regulators in the US for the last 4 years. Even as recently as March, the CEO, Charles Scharf, the new CEO, was in front of the House Financial Services Committee in Congress. Basically they're saying all the right things on the regulatory front. They're also, and this is where the bull case comes in, they're reducing their branches, they're lowering their head count. The regulatory costs are actually now starting to recede. So you've got some costs in there for this year, which is why the earnings have dropped so much, in addition to the sort of business cycle COVID related stuff. But their regulatory costs are now starting to come down. They're focusing on efficiency. They've got new leadership. I think that by now, we know all of the things that they did wrong in the past. I think the regulators have been all over them for quite a long time now. And I think that it's quite, they're pretty close to basically satisfying the regulators. And what is a key bull point here is that at the moment they have a cap on the amount of assets that they can manage. And once the regulators are satisfied, they will lift that punitive cap on their asset growth, which I think is another, sort of string to the bull case. Now, over the last 12 months as well, insiders, so in other words, the C-suite, have actually been buying shares. They've been buying an average around, in the last 12 months, around 26.70. The stock's currently around 32, so a bit below where we are. But that's always a good sign when the management buys. In terms of, there's a lot of potential out there for upgrades as well from the analyst community. So at the moment, only out of all the coverage, only 5 of them are on buys, 17 are on holds, 7 are on sells. So basically, my bet is that this is a recovery play and if you look at the chart, which is up, which we displayed earlier, this thing has come a long way, and I think that the recovery is now underway. I think the bottom is in on this one. At the moment, like a lot of things, it's overbought on the sort of technical side, but I would certainly be buying that on weakness.
What about anything on the other side of that, Jason?
Yeah, so surprise, surprise, I do have a short. So this one is, it's called Invitation Homes, market cap $16 billion. Share price closed yesterday around 28.5. So basically this week's picks, they've got to be gravitating around the $30 mark to get onto my watch list. 28.5 yesterday close. The metrics, so this thing's on a PE ratio for this year of 23 times. For next year, it's 22 times because there's virtually no earnings growth. They're flat in terms of earnings growth this year. They're up 3% according to the analysts for next year. The sector PE is 24 times, so this company is on the same rating as the sector, and 23 times for the sector next year. Earnings growth this year for the sector is basically down 1.5%, and up 6% next year, which is double INVH. Now, what that PE nicely sort of hides is the fact that this thing has got a load of debt. So when you look at the enterprise value, which is taking the debt side of the ledger into account as well as the equity, then you've got a bit of a different picture. So it looks like it's got an average P rating for the sector, but this thing is debt funded, and it will be no surprise to learn that this thing came into life via private equity. And more on that a bit later. So what they do, Invitation Homes, they own and manage large blocks of houses across the US, particularly California, Seattle, Vegas, Denver. That's about 40% of revenues. Florida's about 30%. And then you've got Atlanta and the Carolinas is about 20%. And then you go down to sort of places like Texas and Chicago. Now, what's the kind of profile of their tenants? The average profile is 39 years old, married with kids, making $100,000 a year, paying an average monthly rent of about $1,800. But even so, which doesn't sound too onerous. So there's this thing called a FICO score, or FICO, not sure how you pronounce it, but it's basically a credit rating measurement in the US. So the average INVH renter has got a FICO score of 650. Now the national average is 706, but also sort of if you get lower than 620, you're considered to be subprime. Now, as we like to try and be balanced on in our opinions here, the bull case for this thing is that as of end of last year, they had 96% occupancy, rents rose 3.4%, which produced a 3.8% increase in like-for-like net operating income. And the other kind of bull argument here is that essentially you've got a wave of millennials soon reaching kind of peak home buying age, but unfortunately they don't have enough savings to deposit to put the down payment down. So the demand for single family rentals is predicted to remain robust. Now that's the bull argument as far as I can see. The bear case for me, and I've got quite a few points. Number one, this thing, as I mentioned to you, it's debt funded. So it's on 22.5 times enterprise value to EBITDA. That's trailing EBITDA, okay? And it's got a 2% dividend yield. So this thing could not be described as cheap. Secondly, they've got 80,000 homes, which they've acquired over 8 years. They've done that mainly through debt. They've currently got $8.5 billion of debt, which is 9 times last year's EBITDA. To put that into context, if you want to become an investment grade company, this is not, you want a leverage ratio closer to maximum 6 times EBITDA. This thing's on 9 times. Their interest expense was covered 2.5 times last year, which is, not amazing. I think there's room for the analysts to downgrade it. There's 18 analysts that cover it. 14 of them have it on a buy, 1 on a sell. So in terms of analyst recommendations, that could only go one way. In the last 12 months, we talked about Wells Fargo insiders buying. Now, normally, I don't put so much emphasis on the management selling because, as we know, management in the US in particular get paid enormous amounts of their remuneration is in the form of shares and options. So it's natural. It makes sense to sell, some of your exposure. You don't want all your eggs in one basket. But in the last 12 months, this management has sold a collective $65 million of stock, which is, fairly significant. I think more importantly, I mentioned that this thing was invented by PE. So Blackstone were the big cornerstone investor. They owned as much as 34% as recently as last April, as in April 2019. They now don't own a single share. Now, normally for me, anecdotally, PE selling rings a bell, a rather loud bell. I think another plank to my argument here is if you look at the areas where they're exposed in terms of their main revenues, basically Florida, California, Seattle, that's 50% of their income. These are places that are these are COVID hotspots. And just anecdotally, only back in April, so really at the beginning of this, already 31% of tenants nationally, according to the National Multifamily Housing Council, were failing to pay their rent. That's 31% compared to 18% the year previous. And this is at the beginning of April, so this is before it peaked. To add to their woes, this company also acts as a middle person between customers and utilities, so on their new leases. So they will, in many cases, pay your water, your sewerage, your waste removal services directly, and then you reimburse them as the tenant with obviously some extra margin in terms of your monthly utility management fee. So what happens if you decide to A, not pay your rent because you've been laid off, and B, not bother paying your utilities? So the company is on the hook for the utilities as well with all their new leases. There was also, they've had a pretty large expose in the New York Times as recently as March in terms of lots of customer complaints for various things, broken appliances, mold, leaking roofs, air conditioning units not working. Their reaction to this is they've tried to offload the costs of these repairs from the renters, and they're calling them nuisance fees, which they're trying to incorporate. And effectively, obviously, it just increases your rent. And the interesting thing about that is that last year they stopped disclosing their fee-based revenue in terms of and they're just now calling it other property income, which is probably where these fees get loaded in. And that was up 11% last year, which is a lot more than the overall rental income was up, which was 3.5%. So how much of that is coming in terms of these punitive fees? And then last couple of points, because I know it's getting a bit looking a bit like an assassination. I think they're skimpy on capital spending. Now, this is actually quite an important point because you've got to maintain a certain amount of capital spending to keep your stock up to certain standards. Now, and if they're underspending on their maintenance capex, then that means that their earnings are overstated. Now, what could we use to sort of to judge whether they are underspending or not? Well, according to Freddie Mac, you should account for about 4% of the depreciated value each year. These guys, if they according to them, their normalized capex, maintenance capex, is 1.5% of depreciated book value each year, which means on their 80,000 houses, that's about $3,000 per house, which gets you to $240 million approximately. Last year, they only spent $164 million on maintenance capex. Plus, if you just even put that figure at 3%, the figure would be $500 million per year. They're spending less than $200 million. So, are they skimping on the capital, on the maintenance capital spending? I would say yes. So that could be another, anything for up to $300-400, right? And then lastly, there's now competition, because if you think about what's happened to people like Booking.com and Airbnb, these guys, obviously their businesses have been absolutely crushed because of this. And guess what? If you're an Airbnb host and you've got a mortgage to pay on that property, you are already looking at this market to be renting, to be doing long-term rentals and lets, and that's competition for these guys. So all in all, I think it's expensive. I think it's got several headwinds. It's looking overbought now on the technical side of things. So I would definitely be initiating shorts in this. Obviously, as usual, scale in, leave room to grow, don't overextend. But that's certainly what I would be doing.
I've one quick question about that, actually, as a spread, Jason. You obviously said that Wells Fargo is kind of interest rate sensitive, and I'm wondering whether the short side is sort of inversely sensitive as well. So because they could roll over their debt for cheaper or so on. So if interest rates go down, would that be bad for the spread, do you think, for both sides?
I'm not really suggesting them as a spread. It's obviously part of a much larger portfolio. But you're right. Yeah. Falling interest rates for banks, as we said at the beginning, is not great, because it decreases their interest margins. And yes, of course, anything that's loaded up with a lot of debt benefits from lower interest rates. However, when you're levered to the tune of 9 times EBITDA, and Anthony was talking about this earlier on, I think in terms of United, yes, they raised debt, but at what cost? I think it was 11%, wasn't it?
Yeah, it was.
So, yeah, you've got a very stretched balance sheet there that, of course, yes, it would benefit from lower interest costs. However, can you get lower interest costs when you're so levered?
Absolutely. All right, gents. Well, great to hear from you both again this week. We'll have to finish up there, as always. Fantastic conversation coming from you both, and thank you for taking the time to share those ideas with us. Now, for all of you guys watching and listening, there's a couple of things I quickly want to point out just before I close the show, and that's just about a couple of webinars that we've got coming up. So the first of which is a webinar this Saturday on the 13th of June. The title is Conscious and Unconscious Pathways, hosted by Anton Creel. That's actually an alumni-only webinar, so restricted to our alumni of less than 12 months, I believe. So check your eligibility for that. If you can sign up, then do. And then the other thing I wanted to mention was a new series of webinars that we're doing, similar to the emergency rooms that Jason mentioned earlier. This time we're calling them the War Rooms. It's from the 17th to the 30th of June, so the last 10 trading days of Q2. And basically each trading day, Anton and our senior trading mentors will be giving you market updates, indicator updates, and talking you through some analysis, trade ideas and portfolio maintenance ideas as well. So we're always oversubscribed to that, so do try and sign up early if you can. That wraps things up for today, though. Thank you all for watching, and do make sure you join us next time for another episode of What's on Your Mind.